You know, everyone is always chasing the next massive tech explosion, looking for that one stock that's going to double overnight. But sometimes, I feel like the real money is hiding in the places nobody wants to look.
You mean the boring section of the market?
Exactly. The stuff that puts people to sleep.
Well, if you like boring, you are going to love what we're looking at today. We are breaking down the latest analysis on Elevance Health, ticker ELV. This report is fresh from late January 2026, and honestly, the numbers are screaming something that isn't boring at all.
Let me guess, it's a buy?
It is a strong buy. We're looking at a 70% confidence level here. But the reason why is fascinating. It's not because they invented a new pill, it's because the market has essentially mispriced them.
Mispriced a giant like Elevance? They're huge. How does Wall Street get that wrong?
It comes down to one specific metric that stood out in the report, the forward PEG ratio.
The PEG ratio. Okay, break that down for us.
So usually you look at the PE ratio to see if a stock is expensive, right? Elevance is trading at about 15 times earnings, which is already pretty conservative compared to the broader market, but the PEG ratio compares that price to future growth. Generally, anything under 1.0 is considered undervalued.
And where's Elevance sitting?
It's at 0.94x.
Wow. Okay, so essentially, you're paying less than $1 for $1's worth of future growth.
Precisely. It's like finding a brand name jacket on the clearance rack because a button was loose. The market is looking at their slow growth. Revenue is only projected to grow about 3%, and they are punishing the stock for it, but the analysis suggests they are punishing it too much.
But let's play devil's advocate here. If the revenue growth is only 3%, isn't the market right to be skeptical? I mean, that's barely keeping up with inflation.
That's the bear case, and it's a fair point. The report highlights that free cash flow dropped significantly recently, down over 30%. That is the scary part, and it looks like a company that's stalling.
That sounds like a massive red flag. Cash flow is the lifeblood, right?
It is, but you have to look at the context. This is the healthcare insurance sector. It's defensive. People need health insurance, whether the economy is booming or crashing. Elevance has a massive footprint in government programs like Medicare and Medicaid. That revenue is sticky. It doesn't just disappear.
So, it's a safety play?
It's a value play disguised as a safety play. Even with that cash flow dip, their return on equity is nearly 13%. Management is still efficient. Plus, they've grown their dividend by 43% over the last 3 years. They are paying you to wait for the stock price to catch up to reality.
Paying me to wait sounds good. So, what's the timeline here? When does the market wake up and realize this thing is on the clearance rack?
The analysis points to a 3 to 6 month window for a multiple re-rating. Basically, as soon as the market realizes the sky isn't falling, the valuation should tick up toward the industry average.
And what if it doesn't? What's the risk?
Politics, always politics.
Ah, right, regulations.
Exactly. Their margins are razor thin. We're talking a net profit margin of roughly 2.8%. If the government decides to cut reimbursement rates for Medicare, or if there's a sudden spike in medical costs, like a bad flu season, that 2.8% can vanish pretty fast. That's the medium level risk here.
So you're betting on stability. You're betting that the boring machine keeps chugging along.
I'm betting that the market has overreacted to the slow growth. Look, the price to sales ratio is 0.42x. That highlights just how massive their revenue base is. You're buying a fortress for a discount because the paint is peeling a little bit.
That's a great analogy. It seems like the strategy here isn't about hitting a home run. It's about getting on base safely, while everyone else is striking out on high-risk tech stocks.
Spot on. The report suggests that if they can just stabilize that cash flow and keep the medical costs in check, the stock price has to move up to match the fundamentals. It's simple math.
So, for the listeners sitting on cash right now, looking at a volatile market in 2026, this is the anchor?
It's the anchor. It's not going to make you rich overnight, but at these levels, the downside seems very limited compared to the upside potential. It's a classic buy low, wait and collect dividends scenario.
Sometimes the smartest move is the one that doesn't make your heart race.
Boring wins, races.
Well said. We'll have to check back in 6 months to see if Wall Street finally cleared out that clearance rack.
I have a feeling they will.
Thanks for the deep dive. And to everyone listening, keep looking for value in the shadows. We'll catch you next time.